In 2025, the quietest headline on Wall Street became the loudest warning signal in the entire financial system. Berkshire Hathaway disclosed that its cash and treasury bill position had reached levels no corporation in American history had ever held, more than $370 billion, sitting idle, not invested in stocks, not used for acquisitions, parked in short-term T-bills like a fortress of liquidity earning 5% while Buffett waits. And here's the part most people missed. Buffett didn't just wake up one morning and decide to hoard cash. This was a 3-year migration, a deliberate sequence. From 2022 through 2025, Berkshire steadily sold more equity than it bought. Over $180 billion of net equity sales across 3 years. While buybacks of Berkshire's own shares slowed to a near halt, every quarter told the same story. Prices were high, opportunities were thin. And the most disciplined investor alive was quietly stepping back from the market while everyone else chased AI dreams and momentum trades. But the real question is why? Buffett is a man who hates cash. He has said for decades that cash is a terrible long-term asset. Cash loses value. Cash sits still. Cash is what you reforce to hold when you can find anything intelligent to do. For him to willingly sit on almost $400 billion means he is not looking at the next quarter. He's looking at the next storm. And he's positioning Berkshire not for a correction, but for a moment when liquidity becomes power and patience becomes profit. That moment might arrive in 2026. Look closer, and the pattern becomes clearer. In his 2024 and 2025 shareholder letters, Buffett said he simply can't find anything attractively priced. When the man who bought businesses during world wars, inflation spikes, and banking panics says opportunities have vanished, it isn't an opinion. It's a market diagnosis. It means valuation distortion is severe enough that even the most patient buyer won't touch it. And while investors cheer new market highs, Buffett is building the largest cash war chest the world has ever seen. So what is he seeing? What is he preparing for? Why would a man who thrives in chaos be waiting on the sidelines? Because the numbers around him government deficits. Interest costs approaching $1 trillion a year. Global debt hitting unprecedented levels don't add up. Something in the system is tightening. Something subtle but dangerous is forming beneath the surface. And Buffett's cash isn't fear. It's a message, a silent signal, a macro alert hiding in plain sight. This is the moment most investors misunderstand. Buffett isn't running from the market. He's preparing to buy it. But only when the system breaks enough to reprice everything. Only when the crowd panics. Only when the storm he sees on the horizon finally makes landfall. And if his timing history repeats, that storm sits closest to 2026. Buffett has repeated one line for more than 6 decades. A line almost nobody takes seriously because it sounds too simple to matter. We don't predict markets. We just wait for price and value to disconnect. It's the core of his entire philosophy. He doesn't care about GDP forecasts. It doesn't care about election cycles. He doesn't care what inflation will be next quarter. He only cares about the spread. The distance between what a business is truly worth and what the market is foolish enough to price it at. When that gap is wide, he buys aggressively. When that gap is narrow, he waits. And today, in 2025, heading into 2026, he's waiting harder than ever before. Look at the historical moments when Buffett held elevated cash. Late 1960s, the Nifty 50 bubble made blue-chip stocks absurdly priced. He shut down his partnership because he couldn't find anything worth buying. Early 2000s, dot-com valuations pushed real businesses to sidelines, so he accumulated cash and waited to strike after the collapse. In 2008, before stepping in to rescue Goldman Sachs and other giants, Berkshire was sitting on a significant cash pile, preserved specifically for a crisis moment. And in early 2020, markets peaked in February. Buffett's cash remained high until the pandemic sell-off gave him opportunities. Every time the pattern was the same. Price detached from value. The world insisted the boom would never end. Buffett stepped back. And when the boom cracked, he used cash to take what he wanted. That is why his 2024 to 2025 behavior matters. If price and value were aligned today, Berkshire would not be accumulating T-bills. It would be buying companies. But with short-term treasury bills paying over 5% risk-free, Buffett's natural hurdle rate for any investment has risen. Why should he chase stocks at stretched valuations, thin margins of safety, and compressed forward returns, when he can earn billions simply by waiting? This is the philosophical shift most investors ignore. When interest rates were near zero, holding cash was a penalty. In 2025, cash pays you. Cash compounds. Cash buys time. And Buffett treats time as an asset. The higher the yield on T-bills, the more demanding he becomes with every equity purchase. It's not pessimism, it's mathematics. When safe assets pay 5%, risky assets must offer extraordinary long-term value to compete. And right now, they don't. So Buffett ISNT, predicting a recession in 2026. He is not forecasting an exact moment of failure. He's simply declaring that the price-value equation is broken. The market is priced for perfection. The economy is priced for soft landings. Corporate earnings are priced for smooth skies. And Buffett does not buy perfection. He buys mispricing. And until mispricing appears, he waits in silence, earning billions while the world keeps pretending 2026 will be calm. This is principle number 1. Buffett never tries to guess the future. He only responds when price and value separate. And the fact that he is sitting on the largest cash hoard in human history tells you all you need to know about how far out of sync today as prices have drifted. Buffett has another principle far more controversial than people realize. A principle he rarely states directly, but demonstrates every time the world loses its balance. Liquidity isn't safety. Liquidity is offensive firepower. In a panic, liquidity becomes the most valuable asset in the financial universe. It becomes leverage without borrowing, influence without risk. A silent weapon that only the patient possess when the crowd is blind with fear. And Buffett has spent decades perfecting this weapon. Look back at the moments when he struck hardest. September 2008. Lehman had just collapsed. Global liquidity had frozen. Markets were hemorrhaging. Every CEO in America was terrified. Yet Buffett stepped in with $5 billion for Goldman Sachs, demanded a 10% preferred dividend, plus warrants to buy stock at a price that later delivered billions in profit. Why could he do it? Because he had liquidity when nobody else had courage. In 2011, he did it again with Bank of America. The bank was drowning in mortgage liabilities. Markets priced it like a dying institution. Buffett injected capital on terms so favorable they looked impossible in hindsight. Another 10% preferred dividend, plus warrants that ultimately produced tens of billions. Again, same pattern. Crisis, fear, liquidity, vacuum, and Buffett appearing as the one man with cash and discipline. But the most important part is not the deals, it's the logic behind them. Buffett doesn't hoard cash because he's cautious. He hoards cash because it is the cheapest and most powerful option contract in financial history. Liquidity buys optionality. Optionality buys asymmetric return. And asymmetry is where Buffett quietly dominates every cycle. A look at the landscape leading into 2026. Government debt rising at the fastest. Peacetime pace in U.S. history. Interest cost approaching $1 trillion a year. Global debt above $300 trillion. Every major economy running deficits. Every central bank navigating between inflation and insolvency. These are not normal market conditions. They are pressure points, fault lines. And when fault lines shift, liquidity disappears instantly. Credit markets tighten. Corporate debt cracks. Treasury markets wobble. Banks freeze lending. CEOs panic. And suddenly, even the strongest companies need capital at any price. Buffett positions for that moment, not for the headlines, not for the applause, but for the reset. That's why Berkshire's buybacks have slowed. That's why equity exposure has been trimmed. That's why T-bills have surged. He is building a cash reserve designed not to survive a crash, but to exploit one. When liquidity vanishes, prices collapse. When prices collapse, mispricing appears. When mispricing appears, Buffett steps in not as an investor, but as a lifeline the system desperately needs. And in exchange, he demands terms so favorable they reshape Berkshire's future for decades. This is the deeper meaning of his 2025 cash hoard. It is not a bunker. It is a war chest. It signals that Buffett does not believe markets are prepared for the cost of high rates, the scale of deficits, or the fragility of global credit. It signals that he expects a moment where liquidity once again becomes the scarcest asset in finance. And it signals that when that moment arrives, he intends to be the last buyer standing. That moment could be 2026, not because Buffett says so, but because his balance sheet says so. If you want to understand why Buffett's cash hoard is a macro warning rather than a personal preference, you have to zoom out. Not to the stock market, not to earnings, to the balance sheet of the United States itself. Because that is the battlefield where 2026 is being shaped. And every signal on that battlefield is now flashing red. Start with the simplest one. U.S. federal debt has pushed past $38 trillion. That number isn't abstract. It isn't academic. It's a compounding machine moving faster than the economy that must support it. For decades, rising debt was offset by falling interest rates. The burden grew, but the cost stayed manageable. That era is over. Today, the United States pays nearly $900 billion a year in interest alone, more than defense, more than Medicare, more than the entire Department of Veterans Affairs. Within roughly a year, that interest cost will cross $1 trillion annually. $1 trillion just to stand still. That's a structural drag on growth, on fiscal flexibility, and on resilience. Now layer on top the second signal. Global debt has surpassed $315 trillion. Corporations, households, governments, every part of the system is leveraged. It means the world is exquisitely sensitive to interest rates and volatility. When rates rise, refinancing risk rises. When refinancing risk rises, credit cracks form. When credit cracks form, liquidity dries up. And when liquidity dries up, the world goes looking for the safest asset it can find. Buffett is telling you what he believes that asset will be. Short-term U.S. Treasury bills, not equities, not corporate debt, not long duration, anything. He is choosing the asset that survives when the credit cycle turns. Next signal, valuation. The S&P 500 sits on earnings assumptions that require smooth inflation, smooth productivity, smooth policy, and no tail risks. Yet the government financing structure heading into 2026 is anything but smooth. Rising interest costs mean the Treasury must refinance trillions every year at higher rates. The market has absorbed it so far, but only because liquidity remained high and optimism remained higher. Buffett's cash position implies he believes this optimism is mispriced. He is not betting on collapse. He is betting on reversion. And reversion in an over-leveraged system is painful. Then consider the fiscal math. Every dollar of interest paid is a dollar not spent on defense, infrastructure, research, or stabilizers. Every uptick in rates widens the deficit automatically. The political system is gridlocked. Revenues are volatile. Mandatory spending is on autopilot. And 2026 is the year when several fiscal lines intersect. Higher refinancing costs, slowed economic momentum, and tighter credit conditions. Buffett doesn't need to make speeches about this. His balance sheet already has. But the most important signal is psychological. Markets today are priced as if the era of easy bailouts still exists, as if policymakers can effortlessly step in the moment trouble appears. Yet with interest costs so high, deficits so large, and political consensus so fractured, the margin for intervention is shrinking. A shock in 2026 weather from credit, geopolitics, commercial real estate, or a simple earnings downturn may not be met with unlimited stimulus. It may be met with hesitation, and hesitation is the oxygen crash cycles breathe. Buffett is preparing for that hesitation. When liquidity tightens, when markets panic, when policymakers argue instead of act, cash becomes king. Not cash as a haven cash, as a weapon. $1 trillion interest burden, a $38 trillion debt load, a $300 trillion global leverage tower, a market priced for perfection. None of these are deterministic triggers, but together they form a landscape where one spark can force a repricing. And Buffett's mountain of T-bills says he expects that repricing not sometime this decade, but soon enough that he refuses to be fully invested heading into 2026. He is not sounding the alarm with words. He's sounding it with capital. And capital never lies. If you want the truth about any investor, ignore their interviews and study their positioning. Words are marketing. Positions are confession. And Buffett asks current. Positioning is the clearest confession of caution he has displayed since the late 1990s. The most important part is not what he has bought, but what he has chosen not to buy. Start with Berkshire's own shares. For years, Buffett aggressively repurchased Berkshire's stock whenever he believed it traded below intrinsic value. In 2020 and 2021, buybacks were enormous. But over the last 5 quarters, those buybacks have nearly vanished. That's a critical signal. When Buffett stops buying his own company, one of the businesses he understands more deeply than any other, it means the margin of safety simply isn't there. It means even Berkshire, with its fortress balance sheet, isn't cheap enough relative to the risks he sees forming. And if his own stock isn't cheap, the rest of the market certainly isn't. Next, look at the equity book. Buffett has reduced major holding-selling portions of Apple, exiting positions in several financials, trimming exposure where valuations no longer justify risk. This isn't panic selling. It's controlled retreat. It's the kind of rebalancing that signals a disciplined investor stepping away from crowded trades and overpriced certainty. The world keeps cheering AI booms, tech expansions, and new eras. Buffett keeps doing the same thing he has done in every bubble. He quietly walks backward while everyone else walks forward. Then there's the bond side of the portfolio's short-term U.S. Treasury bills. Berkshire has accumulated an unprecedented wall of T-bills, creating a liquidity position so large it behaves like a shadow central bank. At yields above 5%, these instruments pay Berkshire billions every year to simply wait. Think about that. Buffett is being compensated handsomely for patience. He's earning more from risk-free bills than many companies earn from their operations. And unlike long-term bonds, short-term bills protect him from duration risk, inflation surprises, and policy mistakes. They allow instantaneous redeployment when markets finally break. This brings us to the heart of the playbook. Buffett is preparing for both paths of 2026. If nothing dramatic happens, if the economy glides into a slow growth, high-rate environment Berkshire will still earn astonishing sums from its cash position, tens of billions in interest income. A river of predictable return with zero risk. That's outcome 1. But it's outcome 2 and outcome 3, where the design of his positioning becomes lethal. If valuations reset because earnings falter or multiples compress, Buffett will be ready to buy extraordinary businesses at prices he hasn't seen in 20 years. And if a genuine liquidity crisis arrives triggered by debt, deficits, geopolitics, Or credit fractures Berkshire will be the only balance sheet big enough and trusted enough to write life-saving checks. That's when Buffett's terms become brutal and brilliant. Preferred shares with massive coupons, warrants at distressed prices, deals that reshape entire industries. This is the Buffett playbook, not guessing the future, but building a capital structure that wins regardless of which future arrives. In 2025, that structure is unmistakable. Reduced equity exposure, minimal buybacks, massive T-bill fortress, cash that compounds while he sleeps. And behind it all, the quiet expectation that 2026 will not look like 2024 or 2025. Buffett doesn't need to warn anyone. He's not trying to scare the market. He's building the architecture of opportunity. And if history rhymes, the moment that architecture pays off is never during stability, it's during the break. He's preparing for that break. Buffett never wagers on one future. He builds a position that thrives across many. And right now, heading into 2026, his balance sheet implies three distinct outcomes, three possible worlds each shaped by the same forces: high rates, heavy debt, and fragile liquidity. The market is pricing in only one of these worlds. Buffett is preparing for all of them. That's why he wins. Let's walk through the three outcomes exactly the way Buffett sees them. Quietly, probabilistically, and without drama-only math, incentives, and history. Outcome 1, the soft landing that still hurts scenario. This is the world the crowd believes in. Inflation cools, rates drift slightly lower, earnings hold up, and GDP avoids recession. On the surface, it looks fine. But underneath, the fiscal math keeps deteriorating. Interest costs rise as old debt rolls into new, more expensive rates. Deficits stay enormous. Productivity remains uneven. Corporate margin pressure builds. In this world, markets don't collapse, they simply stagnate. High valuations lose oxygen. Multiples compress slowly. Returns fade. What happens to Buffett here? He wins by doing nothing. Berkshire earns tens of billions from T-bill yields alone. No risk, no volatility, no drama. The market drifts sideways while Buffett's fortress balance sheet quietly outperforms. He won't look heroic, but he won't lose, and that's the point. Buffett never positions for glory. He positions for survival, compounded. Outcome 2, the valuation reset scenario. This is the scenario the market refuses to consider. Not a crash from chaos, but a crash from math. Earnings soften. Multiples come down. The S&P doesn't implode, simply reprices. Down 30%, down 40%. Not because the world ends, because the cost of capital rises and valuations finally obey gravity. This is the moment Buffett waits for. Suddenly, great businesses with long-term competitive advantages trade at prices he hasn't seen since 2009 or 2011. Suddenly, the companies he refused to touch at 25x earnings trade at 10x. Suddenly, Berkshire's cash isn't a drag, it becomes a weapon. A massive, precision-guided purchasing engine. In this world, Berkshire deploys tens or even hundreds of billions. He buys operating businesses, he buys stocks, he buys entire sectors if he chooses. And for the next decade, those investments print money while the market spends years recovering. Outcome 3, the liquidity shock scenario. This is the darkest path, but also the one that produces the most extreme opportunity. A credit event, a geopolitical shock, a treasury market scare, a refinancing crunch. Anything that causes liquidity to vanish for even a few weeks. Banks freeze lending. Corporations scramble for short-term funding. Markets seize. Political leaders hesitate. This is where Buffett becomes the lender of last resort for capitalism. Not the Fed, not the Treasury. Buffett CEOs who mocked conservatism beg him for capital. Financial institutions show up with term sheets in hand. Berkshire writes checks no one else can write because no one else prepared. And Buffett demands brutal, once-in-a-generation terms. 10% preferred yields, equity kickers. Warren struck at prices that look impossible in hindsight. This is how he made billions from Goldman, billions from Bank of America, billions from the chaos others feared. And in 2026, if a liquidity shock hits, Berkshire's cash isn't protection, it's dominance, it's power. It's the ultimate asymmetric bet that only works if the world briefly loses its footing. Now, here's the truth the market is ignoring. Buffett is not trying to guess which of these three outcomes will happen. He is structuring Berkshire so every outcome benefits him. If soft landing, he earns. If valuation reset, he strikes. If liquidity shock, he dictates the terms of survival. The crowd is betting on one future. Buffett is prepared for all three. That's why his cash hoard is not passive, it's predictive. It tells you he expects turbulence, not guaranteed disaster, but unavoidable friction, because no rational investor would hold nearly $400 billion in cash unless they believed the next 2 years would reward patience over enthusiasm. Most people study Buffett by memorizing his quotes. But Buffett has always warned that his words are not the signal. His actions are, and his current positioning the largest cash position in corporate history's the clearest blueprint an individual investor can follow heading into 2026, not because you have his resources, but because you can copy his logic. The principles scale. The discipline scales. The mindset scales. Here is the first translation. Raise your margin of safety. When short-term treasury bills pay over 5%, every investment you make must justify itself beyond that yield. Not through story, not through momentum, through valuation. Buffett refuses to buy assets that barely clear the hurdle. He only buys what exceeds it by a wide margin. If the world's greatest patient buyer sees too little value at today's prices, should assume the market is priced for optimism, not for resilience. Second translation. Being fully invested is not a requirement. Most retail investors feel anxious when holding cash, as if cash is a missed opportunity. But in a high-rate environment with stretched valuations, cash is not a drag, it is optionality. It is the ability to say no when the world says yes. Buffett's 2025 positioning shows that liquidity is a strategic asset, not a failure to invest. Even a personal portfolio can hold 20, 30, or even 40% in cash or short-term bills temporarily, not as a worldview, but as a bridge to better prices. Third translation, prepare your buy list before fear arrives. Buffett always knows what he wants to purchase long before a downturn occurs. He never improvises in the middle of chaos. He acts on a list created during calm periods. For an individual, this means identifying durable businesses, strong balance sheets, consistent cash flow, low leverage, essential products, and management that can survive shocks. When markets fall 40%, you won't suddenly gain clarity. You'll lean on whatever preparation you did now. Fourth translation. Don't try to predict the exact moment of pain. Buffett doesn't attempt to time crashes. He positions for mispricing and waits. You can replicate that mindset. The goal is not to guess the month or the trigger of a downturn. The goal is to stay liquid enough that you never become a forced seller and liquid enough that you can become a buyer the moment the crowd panics. And here is the final translation. Protect capital before chasing return. Buffett's rule no. One is not motivational fluff. It's mathematics. Losing 50% requires a 100% gain to recover. Avoiding big losses is the foundation for long-term compounding. In a fragile macro environment, massive sovereign debt, rising interest costs, and valuations priced for perfection preservation is not caution. It's offense. So what does Buffett's cash hoard warn you about 2026? That this is not the moment to stretch, not the moment to chase fragile rallies, not the moment to ignore valuation. This is the moment to hold more liquidity, demand deeper discounts, and wait for mispricing to reappear. Buffett isn't sitting on cash because he fears the future. He's sitting on cash because the future has not yet given him a price worth paying. And individuals who understand this can turn patience into their strongest advantage. Buffett will never publish a memo titled 2026 Warning. He doesn't forecast recessions. He doesn't predict crashes. He simply moves his capital in ways that reveal what he sees long before the rest of the market notices. And right now, his capital is screaming a message the headlines are too distracted to hear. A record cash reserve, minimal buybacks, reluctance to deploy into richly priced markets. It's an enormous bet on short-term U.S. Treasury bills. This isn't caution for its own sake. It's a battlefield posture, a signal that the next phase of the cycle will reward liquidity and punish complacency, that the world is mispricing risk. That 2026 sits at the intersection of high rates, historic deficits, and fading margin for policy rescue. Your advantage is simple. You don't need to guess the exact trigger. You don't need to mimic his scale. You only need to interpret his signal. When Buffett steps back, you step cautious. When Buffett waits, you watch. When Buffett builds liquidity, you consider doing the same. And when the break finally arrives, whether a valuation reset or a liquidity shock those holding, cash will write their future while everyone else rewrites their mistakes. If you want to follow this story as it unfolds, Buffett's cash shifts. Government interest costs crossing $1 trillion, credit markets tightening, or the moment Berkshire finally deploys tens of billions. Stay with this series. Because the real warnings won't come from economists or commentators. They will come from actions, from balance sheets, from capital that moves before the narrative changes. Buffett has already sent the signal. Your job now is to learn how to read it.